bring Mark Gilman in right now. Mark, head right in here. And we're going to bring in David Lubin with Citigroup. Your note this week was the sharpest note I've seen on the Egyptian military learning from the Turkish military. And some people really push back against this. They're essentially afraid of the Turkish military. What can the Egyptian military learn in the coming months and quarters from the Turkish model?
Well, it's not so much what the Egyptian military can learn, it's whether the relationship between the Turkish military and the Turkish Islamist government that has sustained over the last 8 years provides any kind of model for future developments in Egypt. What has happened in Turkey gradually, imperceptibly over the last few years is that there's been a change in the balance of power between a military that is dedicated to secular values and a mildly Islamist-leaning government that has, in many respects, wrested power away from the Turkish military. And it's been done in a way that hasn't disturbed markets, it hasn't disturbed the real economy. Turkey's risk premium has fallen over the last few years, growth has been strong, and market reforms have remained intact. The question is whether that provides any kind of model for Egypt. And I suspect that there are a number of ways in which that parallel falls down. In the first place, Turkey's peaceful, almost imperceptible revolution has taken place with a very charismatic leader, the Prime Minister Erdogan, who commands a majority in parliament and who has had Turkey's relationship with the European Union as a kind of guarantor of political stability during what otherwise might have been a very unstabilizing period of time in Turkish history. And Egypt doesn't have any of those advantages. Right,
Mark Gilman, to bring you into this with looking at oil, and later on I want to talk about Exxon and Encana, but the idea of the instabilities that David Lubin's talking about, have you seen instabilities in oil supply, or is it just you focus on Saudi Arabia?
Well, we've certainly seen no significant instability in supply up to this point. I think that, the market, whenever we see these kinds of events taking place, is always concerned with respect to Saudi, not only in the context of the size of their production currently, but also that is where any excess capacity of any significance is located currently. The focus is also Saudi because of the inherent ethnic aspects of the Saudi situation, as you might call it. With a minority Sunni-type ruling family in the context of, a significant Shiite influence within the country. So that anytime you see any ethnic fabric to what's going on in the Middle East, concern is always riveted upon Saudi.
Yeah, and here's a chart, folks. This is one we've shown many, many times. This is just Saudi light adjusted for inflation. We take it back to 1980. You can see the spike there is Persian Gulf War, and then up we go in 2008. David Lubin, as we go to the west and we look at Algeria and Libya, these are oil producers. What will you be looking for? What will you be watching this weekend in the political economics of those two very different nations?
Well, the focus over the next few days, aside from Bahrain, where I suspect that people will be continuing to focus their attention, will probably be in Libya, where demonstrations are being spoken about. As far as I'm aware, nothing is planned for Algeria. Demonstrations took place there several days ago, but didn't attract a huge amount of support. Some unknown questions arise about what might happen in Libya. But I think the one thing that we have to acknowledge in the whole evolution of this crisis in the last few weeks is how inherently unpredictable the flow of events has been.
Mark, you look at the unpredictability here in oil. I mean, I know you're looking at the majors. We just saw the banner that says Apache is okay in Western Egypt. Tell us about the oil of Algeria and Libya.
Algeria and Libya are both, relatively speaking, smaller producers currently. There is essentially no excess capacity, to my knowledge, resident in either of those countries' industries currently. Total production from the two combined, probably about 2.4, 2.5 million barrels per day,
right,
which, is certainly not something to trifle with, but notably is less than all indications regarding the excess capacity, in Saudi Arabia as we look at it currently.
David, I'm going to let you get the final couple questions in here, and we'll let you go after the technical difficulties. David Lubin, to bring it back to the affairs of this weekend, Bahrain, is a mystery to so many Americans. Give us the distinctive characteristics of the political economy of the northern Persian Gulf. What do we need to know about Bahrain as we observe the events this weekend?
Well, the essential feature of Bahrain's crisis is the way it kind of overlaps some features of the Egypt-Tunisia crisis with a kind of ethnic dimension. 60 to 70% of the Bahraini population are Shiite, but the regime, the Al-Khalifa regime, which has been in power for some 300 years, is a Sunni regime. So there's a kind of ethnic element to the conflict in Bahrain, which doesn't really exist anywhere else. In Saudi Arabia, although there's a Shiite minority, it's a relatively small minority, which creates arguably its own risks, unpredictable risks, I should say. But in Bahrain, you get this sense in which the regional crisis is kind of morphing into something that has an ethnic dimension as well as simply a political dimension.
David, just one more as we go here. Saudi Arabia, we've seen a silence out of Saudi Arabia. Are they stable?
Yes, I think Saudi Arabia is broadly stable. At Saudi Arabia's level of wealth, there's arguably a kind of contract that the authorities can make with the population, which exchanges subsidies and economic transfers in exchange for political obedience.
Right.
That is a kind of contract that has suited Saudi Arabia very well, and for the time being, we don't see that changing.
Mark, we're talking oil, we're talking a sell on Exxon. I'm sure a lot of our viewers are like, whoa, is it Exxon's doing something right, or is it just too richly priced?
It's actually, Tom, a combination of things. Certainly the richly priced nature of it and the premium valuation that it trades at is an essential element of our posture on the stock. But we've also raised questions as to where the company stands in terms of what I've considered to be a rather urgent upstream rehabilitation program that they're now in the very early stages of, which is trying to compensate for what I believe to have been underinvestment over the better part of the last decade. In that context, a premium valuation such as continues to be in place on these shares, in our view, is just completely unjustified.
A couple critical questions here. Did they sacrifice upstream investment over the pressure to distribute cash to shareholders?
It's a very interesting question, Tom. In our view, part of the difficulty that Exxon is encountering it has to do precisely with that issue. In our view, Exxon, over the better part of the last decade, has overly emphasized return at the expense of growth. The result of that has essentially yielded a consistent and sizable funds flow or free cash balance, right, which in turn they have applied to a fairly consistent and very aggressive share buyback program.
Why haven't they gone out?
We think that's out of whack.
Why have they not gone out and found new upstream finds?
Well, in my view, being a long-standing student of Exxon Mobil, exploration per se has never been one of this organization's strengths. Mm-hmm. So that when you take that into consideration, as well as the perspective and sentiment of not Rex Tillerson, the current CEO, who comes from the upstream side of the business, but rather his predecessor, Lee Raymond, who was a refining and marketing executive throughout his career at Exxon Mobil, I think you pretty much have the answer.
How do they catch up? Do they have to acquire assets? Do they acquire Apache or someone like that, or do they go out the old-fashioned way and find it?
Well, it's very, very difficult, Tom.
It is.
Particularly at a time of elevated prices and reduced access in terms of opportunities available.
Internationally, the governments don't want to play internationally, do they?
Well, host country governments these days are flexing their muscles. They're flexing it as a result of the high price environment. They're flexing their muscles as a result of what they believe to be the enhanced technical and financial capabilities of their own national oil companies, which have grown in stature and expertise considerably over the course of the last 10 years. So what that means is the opportunities available to the Western majors have shrunk. The fiscal terms associated with the opportunities are much less attractive than they've ever really been in the past. So ExxonMobil's trying trying to do something at a very, very difficult time.
I want to bring up elegant chart 2 here, folks. This is a staggering chart. There it is. The state of oil demand, the stark oil demand difference. OECD nations down below. China normalized back a decade. And we all know China's grown in their demand supply, up 200% or so. OECD, it's almost rolling over. Is that going to continue in the future, where the developed nations just ebb away and we see these emerging markets come on?
Tom, the higher the price is, the more likely that trend is going to continue, if not accelerate. And that's really one of the critical issues out there for the worldwide industry. There is little doubt in my mind, and I think, frankly, most observers, that there is significant demand price-oriented elasticity. It's not short-term elasticity; it's medium to longer term. But we're now looking at a period which has had substantial duration at elevated prices, prices that are above what consumers have been accustomed to, and you will see an impact largely in the OECD group and the mature industrialized countries. So that the higher the price, the more likely that graph just continues out and intensifies in terms of the declines in the OECD. What I dispute, to be honest with you, is the extent to which that is an accurate representation of Chinese oil demand.
I don't think anyone. Stockpiling?
Well, I think there's stockpiling going on, and I think, frankly, there is no one out there who really has an accurate handle on what Chinese oil demand has done and is doing currently. And frankly, I got to believe, as I think a reasonably informed observer, that I'm skeptical of double-digit rates of demand growth on a continuing basis from China.
No, we're going to have you back, Mark Gilman. Thank you so much. Mark Gilman with Benchmark Capital. A lot of talk there, folks, about what is the real Chinese oil demand.